We're here to talk about the Silicon Valley real estate market analytics update for August the 3rd. We will then finish up with the Greater Bay Area, which includes 13 counties and 5 regions. We'll come back to this page to explain how you can participate live. I'm Richard Calhoun with Creekside Realty, working with buyers or sellers here in Silicon Valley. Here's the first summary slide, and what it's showing is key indicators. And inventory is important, but what's important to understand is these indicators compared to where they normally are and where they typically are based on the 10-year median. And that's starting last year, going back for 10 years. That's my 10-year median. That's this gray line here. And what we're looking at is the past 14 weeks, which is one quarter with both ends of the quarter on there. You can see you started the quarter with 2,000 inventory, you now have 2,400, so roughly but an increase of 20%. But at the same time, we went from 83% of the normal inventory to 77% of the inventory, which basically says that 20% increase in inventory is less than you normally would expect for this period of time. And you can see we came up and we got fairly close to the gray line through here, but now we've started to pull down and we're getting close to the hot red line. The red line is on all the indicators, a hot market, a hot seller's marketplace. The blue line is a cool buyer's marketplace, and the gray line is a typical, and the purple is the actual data for the current year. So we have less inventory by 23%, but not an unreasonably short inventory, which would be down below the red line. Then if we start over and look at offers, slightly different story here. Yes, there's a shortage, but a shortage of offers indicates a cool marketplace. So we started off the quarter 14 weeks ago at 75% of the level of offers you'd expect. And now you're up to 80%. You've actually gained 5%, and you can see you were originally below the blue line and now you're above the blue line. So you've actually gone from below the least number of offers you'd expect to basically right at the least number of offers you'd expect. And you've been there for quite a long time. If this is 14 weeks, 1, 2, 3, 4, 5. So about the last 9 weeks, you've been basically right on top of the blue line. And right now, this last week, you're slightly above, but not as much as you were below back here. So there's a lack of offers. But the other thing that's noteworthy is if you compare the offers here of 74% to 82, the shortage of offers was greater than the shortage of inventory. And now they're getting closer together because you're at 77 and 81% essentially. So you're only 4 percentage points apart versus basically 8 percentage points apart back here. Moving down to DUI. DUI is the seller-buyer balance, the supply-demand balance. And again, here a low number is a hotter marketplace, which is why the red line is at the bottom. We were above the gray line all quarter, and we're still above the gray line. The speed of the marketplace, the balance of the marketplace is going basically about where you'd expect it to be. So the shortage of inventory is roughly equal to the shortage of offers. Now marketing time, and this is also on here for the clientele, the consumer out there that doesn't like all these numbers and what do they really mean? Well, this is simply what's it take 75% of the sellers to sell their property. And here we were selling in 79%, so 20% shorter time frame than we typically do. And now we're at 93%. So you're still quicker than typical for this time of the year, but again, you've gained some of that, which is slowing down of the marketplace. Now we move on and look at sellers' price reductions. So the advantage of this is we don't have to wait for escrows to close because we simply look at where was their asking price at the time the offer came in, higher, lower, or the same as their asking price. At the beginning of the quarter, 14 weeks ago, you were taking 0.4% price reduction, which was 41% greater reduction than normal. Now you're taking a full percent price reduction. So the amount of the price reductions doubled, but yet the percentage compared to normal is decreased to 16%. So from 41 to 16% is a fairly significant improvement. What is that saying? It's saying that the magnitude of the price reductions are greater now, but they're less now compared to normal. They're more in line with what you normally expect. And you can see that because you're closer to the gray line. In this particular case, you can see you're further away from the blue line because the blue line would be a cool marketplace. And here, the difference between a cool marketplace and a typical marketplace is a much smaller range. And that's basically because the market is more aggressive 14 weeks ago than it is now. And then on here is a lagging indicator, and it's on here just because of the high degree of interest. And this is the overbids. It's sort of the buyer's competitiveness in order to get their offer accepted. And you can see we started the quarter off at 9.7% above the seller's asking price, which is 3% higher than normal. So that means basically when you look at the 10-year median, we're normally 6.7% above the seller's asking price. Now we're only 0.1% above the asking price. So now the typical increase is only 5.9%. You've come down by 4% of the seller's asking price. And part of that is sellers have now seen that the market's hot. So they've been raising their asking prices. At the same time, the market's cooling, and therefore there's more price reductions and less aggressive overbidding because there's no need for it. The buyers are seeing the market's cooling. Now we're looking at all of Silicon Valley, which is Santa Clara, San Mateo, and Alameda counties, all in a blender. And we're looking at the three components. We're starting off with inventory, which is the purple, and you can see how rapidly we've lost inventory. I mean, just the end of June, we had 92% of the level of inventory. So basically getting back in the realm of normal inventory. And now you're down here and I forgot what the number was, 77.9% of the inventory. You've lost about 13% of your inventory in just a matter of 1 month, just during the month of July, basically, because this would have been the last day in June, and now this is the first day in August. So in the month of June, you've lost quite a bit of inventory. Offers, meanwhile, have been fairly stable. In the month of July, they started off here at about 76%. They got down to 74% and they're back up to 76%. That's just statistical bounce. And you can see that there's a fair amount of bounce in these lines. And, that's not really what you're looking for when you're trying to understand what the market's doing. And then the ratio between the two as measured by days unsold inventory has gone from 20%. So we were 20% slower than normal. Now you're only 2% slower than normal. So you're almost back to the typical fast-paced marketplace in Silicon Valley. Yes, that's better for the sellers than the slow pace up here, 10, 15, 20% slower than it typically is. But it's also worse for the buyers that would prefer a slower paced marketplace. Now we're going to focus on the time on the marketplace. So this is how long it takes for the offers to get accepted. This is looking at every transaction. So we have from 10% to 90%. So we're ignoring the 10% of the marketplace that sells the fastest. We're likewise ignoring the 10% of the market that takes the longest period to sell. We're basically looking at the 80 percentile in the middle of the marketplace where the bulk of the market's doing. That purple dotted dashed line here is the current data, but we're going to start off with the blue dotted dashed line down here, which is where we were exactly a year ago. So you can see the purple line is quite a bit higher than the blue line, which means the market is taking longer to sell. What does that mean in real terms? Well, if we look at the 75th percentile, the long typical seller, a year ago, they were taking 20 days to sell their property, and now they're taking 26 days. So they're taking almost a full week, 30% longer to sell. So, it is a noticeable slowdown in the marketplace. Now, if you look at half the sellers, I mean, the change is almost insignificant, and it's going to be harder to read the exact numbers. I'm going to call it close to 10 days to sell your property here for 50%. And now we're at 11 or 12 days. So just a slight increase in how long it's taking, but that's still about a 10% longer marketing time. So it's still a fast-paced marketplace, but it is slower. Now what we're going to do is step through and look at each line, and we're going to start jumping. I'm calling them months, but none of my data is monthly data. It's going to be 4 or 5 weeks to try to keep the same day roughly. So August 30th is closer to August 2nd, October 4th. So we're jumping roughly a month at a time, but it's either going to be 4 or 5 weeks. And then we're going to, when we get down to 3 months, which is 13 weeks ago, the next data slide is 12 weeks. So you can see the difference. So here we go. So you can see a year ago we were bouncing and then you're slowing down. And there's the slowest time we had at the beginning of the year. Now you had the spring run up. And right about here is the peak of the marketplace, right around May, the month of April. And now you're slowing down, and now you got sort of the plateau. And here's where you really start slowing down. So the movements from week to week, although there was 3 weeks in a row. So there's a movement, 2 weeks in a row. Now another movement, another 2 weeks in a row, and then another movement. and then 2 weeks in a row. That step function is not uncommon, and it's not my data, it's just the way the market reacts. So you can see that, again, as I said at the beginning, today's market of the purple line is cooler than we were a year ago, so the market is slower than where it was in August 2nd of 2023. And I compare the same date of the year after year. You can see August 2nd, 2024, August 2nd, 2023. So I'm not comparing necessarily the same days of the week, which I would also like to do, but you can't have both. And that's because and in a typical year, you have 1 extra day. On leap year, you have 2 extra days. And because of that discontinuity for leap year, I start my real estate statistical year on March the 1st. That's my first data point for the real estate year. And then I go back 35 days. And I jump forward a week at a time, 7 days, until I get back around to February 21st. And then I jump 8 days back up to March 1st in a normal year. And I jump 9 days on leap years to get back to March 1st. So March 1st is sort of my benchmark. And that's the day I acquired data. So this August 2nd is the day I acquired the data, going back 35 days prior to that. So this data that we're going over is actually data from August 1st back to June 28th, I believe, is my 35th day. Here's your ask price reduction. So this is how much the sellers are reducing their ask price to get the offer to come in. Again, the purple dotted dash line is the current year, and you can see that's below the blue dotted dash line, which is a cooler marketplace because you're closer to the worst, coolest year we've ever had. The hottest year is basically a horizontal line up here with sellers taking no price reductions. And here, instead of looking at the 10 to 90 percentile, I'm looking at the 2.5 percentile to the 17.5 percentile. So I'm only looking at 15% of the marketplace, and that's only the 15% of the marketplace that's taking some of the largest price reductions. And the reason I'm doing that is the vast majority of the sellers don't take any price reductions whatsoever, even in a relatively cool marketplace. So you don't want to have 85% of your data sitting there at essentially zero. Stepping through, you can see the slowdown right about coming up. Right here is sort of the slowest of the year, 7 months ago, and then a huge spring jump up. And there's your peak of the marketplace. And then sellers started reducing prices 3 months ago. And you can see the amount of pricing reductions has sort of increased almost every week. And again, there's a lot of this pairing where there's 2 weeks fairly close together and then a jump, and 2 weeks close together and then a jump, and 2 weeks close together. And the pattern doesn't always hold, but it's sort of interesting that that's sort of a typical pattern. And so here is the current line, which is basically essentially the worst line we are. Now, if we go back 1 week to there's not much difference. There's not much difference there. So you basically have 3 weeks where the price reductions that the sellers have been doing have been roughly the same. And I would expect this. We saw last year those price reductions to increase in magnitude and frequency for the balance of the year until we get over to the new year. Now we're looking at the overbidding, and be careful with overbidding because there's a lagging indicator, and that means this data lags behind 3 to 6 weeks. But the other thing I have noticed is the buyers that overbid the most are being aggressive in their offers, and they're also typically coming in with cash or with a loan that's all approved, and they're closing much faster than the 3 to 6 weeks that's typical. They're closing in 1 to 3 weeks. And so the lag time on where the overbidding shifts is not as great as one would expect. It's not that 4 to 6 weeks, it's more like 3 or 4 weeks. So just as an observation, here you can see the purple line is very close to the blue line, but again is on the cool side. And last week, I believe, and it might have been the week before, it might have been 2 weeks ago, was the first time that this indicator was cooler than a year ago. And again, that's, it's different metrics, but again, now it is cooler than a year ago. And we're stepping through, and you can see the market's gonna bounce around a little bit at this time of the year. And then 8 months ago, you start really stepping down. 6 months ago, sort of the bottom of the marketplace. 5 months ago, you're starting to accelerate. The peak of the market's right there about 3 months ago. 12 weeks ago is probably a little bit more accurate. But then you're plateaued for a little bit while you're closing those loans. And now you're consistently stepping down week after week after week. And so now we're approaching 2 weeks ago, 1 week ago. And this graph is actually a little bit smoother in the fact that it doesn't seem to have clumps of data that are roughly the same. Now moving on to the individual indicators, and again, this is all Silicon Valley. We will be getting into micro markets, which I believe are the important factors, because just like the Bay Area doesn't move together, each county doesn't move together, and each market within each county doesn't move together. But this is first to give you an overview. And again, the red line is a lack of inventory, a hot marketplace. This is the gray line is the typical marketplace, and the blue line is a lot of inventory, a cool marketplace. And basically what you can do is sort of take the purple line, which is the current data, and sort of project the gray line's movement onto it. And that's about where you'd expect the market to be. So, and you have to use a little judgment call. So you sort of have this plateauing of inventory at this time of the year. So likewise, I'd expect a plateauing of the inventory for the next several weeks for the current year. I wouldn't expect huge increases or huge decreases. I would expect a decrease coming up here for the holiday, which is going to be Labor Day on September the 3rd this year, I believe. But, it's basically a way of telling you what's going on. The other thing that you need to pay attention to is starting on January 1st, 2023, I've expanded out the horizontal axis so you can see the data and yet have the 10 years data. So this is the 10 years data that I'm using for my gray line. And then you're seeing the current 1 full year on the expanded horizontal axis, plus the current data. So inventory is between a hot marketplace and a typical marketplace, and it's following sort of the typical trend, and nothing really noteworthy there other than there is lack of inventory. Here you can see the lack of inventory was getting less significant going into July the 1st. In the month of July, the inventory has been disappearing, and we're back down below 80% of the inventory you'd expect now. Here's looking at offers. Now, here it's noteworthy that the offers are below the blue line by actually quite a bit, because in the last time, when you look at the median of the past 10 years, the cool marketplace has been actually increasing. What would I anticipate going forward? I would anticipate more the gray line pattern. So I would expect this data to probably be more flat to going down. So we're going to be having a shortage of offers going forward, in my opinion. The other thing I want to point out up here is my little note to myself, not pending. A lot of people look at pending transactions, and it depends on how you define pending, but a lot of people define pending as those transactions that are in escrow and are currently pending. I look at offers accepted, and the reason I do that is I want those overbid aggressive cash buyers that close in 1 week to count the same as those troubled loans that take 10 weeks to close. If you look at a pending transaction for 10 weeks that it's in, when it's in a loan that's having challenges, that's going to impact your data longer than that quick 1 week almost cash buyer or a pre-approved buyer completely underwritten. So it's important to understand the differences here between pending and offers. I look at offers accepted, so each transaction carries the same weight in my statistical analysis. Here you can see that we've had a lack of offers, where you can see we're down somewhere right around 75%. We're up from the low of 70% most of 2023. We can see the sharp improvement as far as more offers coming in. But again, the month of July has seen some of that improvement go away. Here's your days of unsold inventory, and this is the balance. So between the first 3 that we've talked about in this metric, this is the more important one, because it tells you sort of the speed, the supply-demand balance, the turnover rate, whatever you want to call it. But here you can see we're getting basically back down to normal. Now, keep in mind that a normal speed marketplace for Silicon Valley is actually a fast-paced marketplace. So the fact that we're at normal does not mean it's going to be a slow marketplace. And in rough terms, it's saying that we would sell all our existing inventory in 6 weeks, 42 days, which is a pretty fast marketplace. It is coincidentally about the level at which I say we're in a balanced marketplace. So buyers and sellers sort of have an even footing. Here you can see compared to the normal, so you can see the huge improvement compared to normal. So just at the beginning of July, we were 20% above our DUI. And again, with DUI, a slow number is a more aggressive number. So you're 20% slower than normal. And now that number is improved, and it's only probably about 3 or 4% more than normal. It may not even be 3%, because here's a 10%. So it's probably about closer to 2% slower than normal. And that's the level of which I would call it normal. Anything sort of in this 10, 12% range of normal, I would consider normal. Here's your marketing time. You can see marketing time has been following right on top of the gray line for the month of July. This week, it's basically been flat when typically it increases. Again, I would typically expect, since right now it's been following, I'd expect it to follow. So my best estimate would be next week, and for the balance of the year, you'd expect the marketing time to get longer and longer and longer. Here you can see it's improved compared to normal. So you've gone from a slightly longer of 2% longer to, probably about 8% faster days on market. So sellers are spending about 8% less time on the marketplace this year than they typically do based on the past 10 years. Here's the seller's ask price reduction. So even though the marketing time is less than normal, the price reductions the sellers are taking are greater than normal. And it's basically following either the gray line, which is it's doing a fairly good job. It's also following the blue line. So I'd expect these price decreases to continue to get more aggressive as we get into the year. So basically what it's saying, the 10% of the sellers that are taking the largest price reductions are taking basically a 12% price reduction right now. And in a typical marketplace at this time of the year, they're taking about a 12% price reduction. So even in a hot marketplace, the 10% of the sellers that are taking the biggest price reductions are still taking 5% price reductions. So keep that in mind. I'm aggressively looking at the outlying area to get a decent indicator of what the marketplace is doing. Here you are compared to normal. So sellers are taking roughly 20% more price reductions. This is the average. So that was looking at the most aggressive sellers. Now we're looking at the average sellers price reduction. So the average seller's only doing a 1% price reduction, which is probably what people are more used to seeing. Almost everybody quotes average. I'm the only one that I know that looks at the extreme, but looking at the extreme gives you a better indication, in my opinion, of what the market's doing. You can see that we're following the gray line fairly closely, and that's the pattern I'd expect to see for the balance of the year. Here's compared to normal. Now what we're looking at is those frequency of price reductions. So how common are the price reductions? And you can see 15%, it's a little bit higher than that. So it's about 15.5% of the sellers are doing a price reduction, basically typical on top of the gray line. You can see the frequency of sellers doing price reductions has been very, very close to normal for a longer period of time. What does that say? It says that the sellers that are willing to do price reductions is a fairly standard number, and the magnitude of their price adjustments is just higher currently. Here's the frequency compared to normal, and you can see how we've been bouncing on both sides of normal for all of 2024. Here's the average overbid. So now we're looking over and seeing what the buyers are doing. Look at the significant decrease right here on the right-hand side of the axis. You peek back here, and it's sort of hard for me to guess. I'm not seeing my quarterly lines, and I will try to add those back in. But knowing that the second quarter is here, this is probably right around April 15th, April 19th, right here was sort of the peak. So from the middle of April to the beginning of August, look at the decrease. That's a 4% reduction in the amount the buyers are overbidding the seller's ask price. Here's compared to normal. So you were getting basically 3% above the typical overbidding, and right now you're right at the typical overbidding. And you can see how it's fairly accurate because here the quarter lines are showing. So you can see this would have been April 1st. So I'm past April 1st. So somewhere around that April 19th, April 26th timeframe, May 1st, maybe, but May 1st is, maybe even May 1st. Got a plateau. So basically the beginning of the plateau was probably around April the 19th, and the end of the plateau was probably somewhere around May the 8th. Here's the frequency of overbidding compared to normal. So you can see we're more frequent overbidding just, at that same time frame. This is April 1st. This is July 1st. Here it's a little bit lagging. Now, remember, frequency of overbidding is going to be probably closer to that 3 to 6 week time lag. And that's because to get the frequency, you need to have the bulk of the escrows to be closing. But again, you went from more frequent overbidding to now right at frequent overbidding. And again, you'd expect, based on no additional information, to follow the gray typical pattern, because real estate is very cyclical here in Silicon Valley. It follows a very seasonal annual cycle. Here's the overbidding compared to normal. So you can see you had a little bit of overbidding more than normal. and now you're basically right at normal. Here's your long-term appreciation on log paper. The blue sloped line is sort of my estimation of appreciation. You can see you have this run up every year right around the second quarter where prices go quite a bit above. And then you also have this valley after right about the end of the year. So you can see it very pronounced. When we were on fire in 2021, it was so on fire, the valley became a plateau and then it increased again. So I would expect this decrease of pricing to continue to the end of the year and then turn around and reverse, go back up. Here's looking at estimated payments. This assumes an 80% loan, which is very untypical on the 90% loan. But if someone did that, they'd have a monthly payment about $26,000. The typical home buyer in Silicon Valley is having a mortgage payment of about $12,500, and the buyer that's buying the cheapest 10% home is having a mortgage payment just under $7,000 a month. Here's your active inventory. Now what we're doing is comparing the three counties: Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the blue. Santa Clara County has less inventory probably than the other two counties. You can see that Santa Clara and Alameda County were fairly close together all the time, and now Santa Clara County has a significant lack of inventory compared to Alameda County, and San Mateo County has almost their normal level of inventory. Offers accepted. Here, Santa Clara County and Alameda County are much closer together, which would indicate that the speed of the marketplace in Santa Clara County is faster than in Alameda County. You can see San Mateo County is clearly lacking their offers still. Here's your days unsold inventory showing that Santa Clara County is by far the fastest marketplace out there. We're this week at about 34 days, down from about 37 days just last week. Then you have San Mateo County coming in second at something like 44 days of unsold inventory, and Alameda County coming in at 50 days of unsold inventory. Here's your 75 percentile days on marketplace. So this is the long typical seller. It's basically 22 days, 3 weeks for the Santa Clara County, 28 days for San Mateo County. So 4 weeks, a full week longer than Santa Clara, and Alameda County is coming in at 29 days. Here's the magnitude of ask price reductions, and this is average for ask price reductions. So even though Alameda County was doing better on DUI, I think, than San Mateo County, if I remember correctly, I'd have to go back and check. Alameda County is doing the most price reductions, followed by San Mateo County, and Santa Clara County in the blue is doing the least amount of price reductions. And for Santa Clara County, just to put it in perspective, that's 0.8% price reduction. So not even 1%. And in Alameda County, where it's the most price reductions, it's a 1.2% price reduction. And that's on average. And you have to keep in mind that the vast majority of the sellers do no price adjustment at all. This is the frequency of price reductions. So you can see that in Santa Clara and San Mateo County, it's only 14% of the sellers are doing price reductions. In Alameda County, it's 18% of the sellers are doing price reductions. So again, a small percentage, less than a fifth of the marketplace is doing price reductions in Alameda County, which is most frequent price reductions. Here's the overbidding. Even though the sellers are doing the most price reductions in Alameda County, their buyers are doing the most overbidding, and they're doing the least overbidding in Santa Clara County. Clearly not what you'd expect based on the pace of the marketplace, because Santa Clara County had the fastest marketing time. The 75th percentile, I think, was 21 days. And now it's getting the least amount of overbidding. Frequency of overbidding is at 70% for both Alameda and Santa Clara County. It's down at 62% for San Mateo County. Still aggressive, but you can see it's clearly down from the peak that was basically middle of April, no later than beginning of May. Here's the long-term appreciation. Because the prices are coming down, your appreciation and measured by the last 9 months of 2015 is coming down, but Santa Clara County still has the most appreciation, somewhere around 95% appreciation. Alameda County and San Mateo County are neck and neck at about 75% appreciation, and that's basically since 2015. Here's your sale price. San Mateo County is just above Santa Clara at $2 million. Santa Clara County is about 1.9 million. And Alameda County is the cheapest county at about 1.3 million. And the lines are on here, so you can see that in all cases now, you're below the peak pricing of 2022. San Mateo County and Alameda County are basically at their peak pricing for 2021. Santa Clara County is still quite a bit above the peak pricing. So if I was to guess, I would see more price reductions in Santa Clara to get it in line with the others. But Santa Clara has a lot of affordable areas like Milpitas and Morgan Hill that have become more desirable. Here's the same information on regular paper for those that prefer it. I will admit it's easy to read the lines. So you have 2 million, like I said, for San Mateo County. It looks like Santa Clara County is closer to 1.85, and Alameda County is at the 1.3. Here's the estimated payments for the three counties. Alameda County is at $10,000 a month payment. Santa Clara County is going to be at $14,000, and San Mateo County is just over $15,000 a month per payment, assuming an 80% 30-year fixed at the national rate. And you can get lower than the national rate. I forgot what the number was, but it was about 6.75%. And Wells Fargo, I think, was at 6% for jumbo money, which is what most of the people in Silicon Valley would be borrowing. Here's a summary of the micro markets that we're going to be going over. The first two are really don't give you indications of the market conditions. These are your key indicators that tell you where the market's going, whether you're a hot or cool marketplace. The two orange ones are a lagging indicator because you need the sale price. Then you have just depreciation and sold price. And instead of just following the median price, the middle number, as most folks do, I follow the cheapest 10 percentile as well as the most expensive 90 percentile. And then there's the payments corresponding to the same properties. So here's your lack of inventory. You can see the lack of inventory is in most areas, but more pronounced in Alameda County and Santa Clara County. Most of San Mateo County is sort of at that balanced marketplace. The base cities would be the area that would have the shortage. This clearly shows the lack of offers. The only area that's about normal is Palo Alto and Mountain View and the offers area. You have, and I guess Cupertino, Sunnyvale, Palo Alto, sort of the west area of Santa Clara County. Most of San Mateo County has a fairly significant shortage of offers, and even your outlying areas in Santa Clara County and Alameda County have a shortage of offers. So clearly a shortage of offers and a shortage of inventory reign. Here's your balance. You can see the only hot area is Cupertino, Sunnyvale. The cool area is the coast and the expensive areas in San Mateo County, as well as North San Mateo County. So San Mateo County is basically a slower marketplace compared to the 10 years. And I believe that's related to the pandemic. And basically your Alameda, Santa Clara County is sort of a normal marketplace as far as the DUI, the speed of the marketplace. Here's just the raw count. So this is, going to be a hot marketplace. So Santa Clara County is going to be basically less than 6 weeks, which is why it's pink in color. Most of your Alameda County area is going to be close to 6 weeks, which is why it's sort of that balanced color. It's going to be 6 to 11 weeks. And San Mateo County is on both sides. It's got the blue and it's also got some red. Moving on to marketing time. So those that don't want just straight facts, how long does it take the long typical seller to sell? Anything under 21 days basically gets the pink color, and you can see it's sort of balanced. So even though we're sort of having a slower marketplace than we typically do, it's fast paced in the fact that sellers are still selling in 3 weeks, the long typical seller. Here's your ask price reductions. So they're completely normal as far as the average price reductions. And I define normal as to be anything from 1/4% to 1% price reduction. So that the price reductions are basically right around that 0.5% price reduction mark. Here's the frequency of price reductions. So less price reductions, the red of the color. The San Mateo County coast has a lot of price reductions going on, and the outlying areas are getting sort of more balanced. Here's your overbid magnitude, fairly by 9 coloring, a lot of pink, but no real red. The reddest is going to be the city of Alameda and Berkeley at 17% of the sellers getting more than their asking price. And the least is going to be the San Mateo County coast, where sellers are actually taking a 2% price reduction when the offers come in. Here's looking at the frequency of overbidding. Least frequent in San Mateo County coast, with only 17% of sellers getting more than their ask price. The reddest color I'm seeing right off the bat is, again, Berkeley and the city of Alameda at 81% of the sellers getting more than their asking price. Close behind is Milpitas, Berryessa, North Valley, Santa Teresa. sort of the more affordable areas in Silicon Valley. Here's your long-term appreciation. That same area, Milpitas, Berryessa, North Valley, Blossom Valley, and Santa Teresa's had the most appreciation at 96%. The area that's had the least appreciation I'm seeing is the coast at 46%, and that's since 2015. Here's your current price, and you have the cheapest 10 percentile on the right, the median in the middle in number, and the most expensive 10 percentile you'd expect to see on the right-hand side. So you have three numbers, so you have it sandwiched. The blue colors are your more affordable areas, the red areas are the more expensive areas, the white areas are those areas close to the median price for Silicon Valley. This is on here to show that we continue to lock the number of offers. We are doing better than last year, but we are the 24th slowest year out of the last 25. So we're really only beating 2023, so it's still a pretty slow year. Here's your numbers for the three different counties, Santa Clara, San Mateo, and Alameda County, as well as Santa Clara County together. This is sort of the data we've gone over, but this gives you the actual raw numbers if you want them. And with that, we get back to, we've been talking about Silicon Valley real estate market's analytical update for August 6th. We will be going over the Greater Bay Area, which is 5 regions, 13 counties. If you type in this blue long YouTube archive, you get to the archives of my presentation, or you can type in the shorter green root URL. You add 2024 to the green root URL, and you get to the live presentation Saturday morning at 9. The passcode, if it asks for it, any particular episode, the green root URL. I'm sorry, add in the letter H for handout, and then in 2024-08-03, and the handout was posted, so you can get that down and look at it. It's 66 slides, I believe, that we've gone over. In any specific episode, you type in the green root URL, the year, month, date, code. I'm Richard Calhoun, Creekside Realty. Contact information is there for you. And I'm representing buyers or sellers here in Silicon Valley. Happy to talk to you about statistics or your real estate needs. Let me see if anyone's got any questions. Not seeing any unmuted mics. I'll move on to the Greater Bay Area. Here we're looking at 5 regions. The first region is Silicon Valley, which we've discussed in detail already. Then we have the cities, San Francisco and Marin, North Bay, Sonoma, Napa, Solano, Contra Costa, Central Valley being San Joaquin and Sacramento, and the Central Coast being Santa Cruz and Monterey. This is single-family homes, detached and attached duet homes. Here we're looking at the greater inventory. You can see that Silicon Valley inventory is below where it's been, but if you look at Central Valley and in the yellow and North Bay in the gray, their inventory is lacking even more so, it would appear to me, just looking at the numbers. You know, they're up here somewhere around 5,000 typically. They're just over 2,500, so they have roughly half the inventory that they typically do in rough numbers. Silicon Valley would be somewhere right around 3,000, and it's somewhere around 2,500, so it's only missing a sixth of its inventory versus 3/6. So quite a bit of difference in inventory. You come down to Central Coast, and it's losing, you know, maybe instead of 1,200, it's got maybe 700, 7,500. So it's off by, what would that be, about a third. And San Mateo County is normally somewhere around, maybe 900, and it's down around 500. So again, losing all 5 regions are down on their inventory. Here's your number of offers. What's really noteworthy here is look at Silicon Valley. It peaked basically midway through second quarter and has been coming down. But meanwhile, both the Central Valley and the North Bay in the gray have been increasing this during this third quarter. So they're going in opposite directions. Central Coast are basically flat. So they're really not much, and there's much smaller areas. So these are the 3 big geographical area, big number of transactions, the big share of the market. And you have Silicon Valley going down, and you have North Bay and Central Valley going up. So very interesting to see the difference. And you can see that historically they have moved together pretty closely at the same time. So the fact that they're going in opposite directions and noticeably in opposite directions is noteworthy. Here's the days of unsold inventory. Silicon Valley is still the fastest paced marketplace, followed by the cities, followed by the Central Valley, then the North Bay, and the Central Coast is the slowest at 80 days of unsold inventory. And if you look historically, that's where you typically are. The coast is the slowest out of the five, and Silicon Valley is the hottest out of the five. And the other three regions are pretty close together in between, and that's exactly what we have now. Marketing time, Silicon Valley has got the fastest marketing time at 21 days, followed by the Central Valley, followed by the cities and Central Coast. And here the marketing time is the longest for the North Bay. The actual time for 75% of the sellers to sell is the highest, and that would be about 43 days in the North Bay. Here's your ask price reductions, and this is the average, so it's a fairly small number. You have 1% in Silicon Valley, followed by Central Valley at about 1.25%, 1.75% for North Bay, then the cities at just 1.75% for the North Bay, basically 2% for both the San Francisco, Marin, the cities, and the Central Coast. So you can see the price reductions are double for the slowest, the areas with the biggest price reductions as they are for the ones with the least. All five regions are having more price reductions. So you can see they're all going down at different paces, but all sort of, together, sort of like you'd expect them to be. Here's your sellers' frequency of price reductions. All of them are increasing at roughly the same rate. There's really no change. The area that's taking the most price reductions right now is, again, the North Bay. The one with the least is Silicon Valley. Here's the overbid. So now we're flipping over and looking at what overbidding is. And as we've typically have for the last 10 years, Silicon Valley and the cities has the highest and fairly close together overbidding. Your North Bay, Central Valley, and Central Coast are much lower and sort of spread out and roughly in the order they typically are for the past 10 years. So that really shows you how predictable the marketplace is. Here's your frequency of overbidding. Again, the order is the same as it typically is. The biggest difference is the separation between the cities and Silicon Valley. And I would even say that that's not much of a separation. Silicon Valley is here at about 70% of the sellers getting overbid, and the cities is somewhere around 57%. And it's actually 68%, that's 57%. So an 11 percentage difference. Here's your long-term appreciation. Very noteworthy. The area that's doing least well since the pandemic is the cities, San Francisco and Marin. The area that had been doing the best was the Central Valley, and it's coming out. Silicon Valley came up this year and did better than the other regions, so it came out on top. But once again, the Central Valley is sort of on the top, and that's sort of, I think, in line with the remote working being more prevalent. Here, all the regions are going down except for the Central Valley, which is continuing to climb. So as people see they can't afford to buy closer in, they're moving out for the more affordable area. Here's your sold price. You can see that the cities is actually below Silicon Valley. Silicon Valley is here at about 1.650, so 1650, and the cities is at 1600. So even though Alameda County pulls down Silicon Valley, it's still higher than San Francisco and Marin. And that doesn't happen very often. It happened right through here. We got close all through here, and now we're above. So we're sort of in fairly rare territory. Then you have the Central Coast being the next, North Bay and Central Valley. Central Valley is the most stable on the pricing, sort of the longer term trend. North Bay has a little bit more fluctuations, and then Central Coast has more. And then Silicon Valley sort of has this huge or half sine wave every year. Then here's your monthly estimated payments. And again, Silicon Valley is slightly higher than the cities, which we saw on price. And you'd expect the payments to be the same as the price, since I'm assuming an 80% loan and making estimates for property tax and insurance, followed by the Central Coast, North Bay, and Central Valley. So these are in direct line of their price, their payments, and it just gives you an idea of what the monthly payments are. Now, you get lower payments by doing a 7-year adjustable, by doing a jumbo loan, by putting more money down, by having relationship banking with the institution that does your home mortgage. Here's the different numbers for the regions. I have each county on here. I also have Silicon Valley and in the Bay Area, which is the 9 counties that touch the Bay. I don't do the 5 regions, all 5 regions cumulatively. And with that, I'll see if there's any questions. Not seeing any unmuted mics. Have a great week. Thanks for joining. Take care. Bye for now.